What's up, everybody? Thanks for tuning in today to another video here on Selling Vega. It's an exciting day as we continue our charts, patterns, and indicator series. Talk about our first indicator today, moving averages. What they are, how they're calculated, the different types, and how traders use the information they provide us. It's going to be the first of several technical indicators I cover in the coming weeks. So please like and subscribe to our page and hit that alert button so you know firsthand when those videos drop. Now, without further ado, let's get started. All right, guys, so let's get right into it. What is a moving average? Well, a moving average is a tool that smooths out price data by creating a constantly updating average price that's based on a time frame. Usually that time frame's in days. In finance, moving averages are often used in technical analysis to keep track of price trends and as support and resistance levels themselves. So some of the most common moving average time periods are the 9, the 20, the 50, the 100, and 200. All those numbers are days. So let's use the 20-day as a quick example. So you see this orange line here. The 20-day moving average at any time is going to be the average price of that stock for the previous 20 days. So for today's action on August 5th, the moving average that you see on the chart today reflects the last 20 days of trading. So there are two types of moving averages that are the most commonly used. One is the simple moving average, or SMA. The equation for the SMA can be seen here. And this is calculated by taking just the arithmetic mean of the previous prices for the time period you're using. So just taking all the previous prices over however many days you're using for your moving average, and then dividing it by the number of those days. So that way every single price is weighted the exact same in its impact on what the ultimate moving average is. And then you have the exponential moving average, whose equation can be seen here, also called the EMA. This type of moving average gives more weight to recent prices in an attempt to make it more responsive to new information. To calculate this, first you have to compute the simple moving average over that particular time period, and then you add a smoothing factor, which you can see with this formula, and the smoothing factor will combine with the previous moving average to arrive at its current value. And the way that this equation is set up, it'll give a higher weighting to recent prices, so it is more responsive in that sense, and sometimes more useful. Some traders do like it better for that reason. Now here on the chart, we can show you both the SMA and EMA for various time periods, so let's just use the 20-day. So as we can see, these two lines are the simple moving average and the exponential moving average for the 20-day time period. Let me get these equations out of the way so that way you can see. Now, depending on what the more recent price action is doing, these moving averages will vary, and you can see the slight differences on the chart, and sometimes they're closer and sometimes they're further away. For example, recent upward trending prices will mean the EMAs will rise faster than the SMAs, and recent downward trending prices will mean the EMAs will fall faster than the SMAs. In terms of popularity, I don't necessarily think one is more popular than the other, as I've seen investors and traders using one or both for my whole trading career. So here's how you find the moving averages on TradingView. You go up to the top here where it says indicators, and this is going to show you basically TradingView has every single indicator under the sun built in to its charts, so you can add anything you want here. So if you scroll down, you'll find moving averages. You can also just type in moving averages right here. When it just says moving average, this is the simple moving average, or the SMA, and the moving average exponential is the EMA, what I just described. So let's just add here. You click on this, it'll pop up in the on the left side right here, which is where all your indicators are going to be. So this one just came in. You click on settings for the indicator itself, and this is where you can, change the color of the line, change the thickness, and you can also change the time period. So, this is where you change it if you want from the 9-day to 20-day, 50-day, 100-day, whatever time period that you want to set it at. And that's how you add it to your charts. So you can see on the left side here, I have, the 9, 20, 50, 200, all for the SMA, and then I also have all the EMAs as well, the 9, 20, 50, and 200 for the EMAs. Alright, so let's move into the second half of this video, which is how do traders use moving averages? The first way that they're used is to confirm the current trend of the asset. So if we see everything on our screen here with the S&P 500, we can see that basically since post-COVID, or since post-COVID crash, which was here, it's been in a clear uptrend. And you can confirm that by all of the moving averages that are on my screen trending in that upward trajectory. So visually, that's the first way that moving averages are used. The second way that they're used is to plot resistance or support levels that traders or algorithms will use, who will then place high volume buys or sells at these important levels. In each level of the moving average, or each moving average in itself, is an inflection point in the market, most likely where traders or investors of all kinds will be increasing their volume based on how they perceive the stock price touching this indicator at this time. That's often why we see volatility and a reaction to hitting a moving average, and that volatility can be in either direction. The longer the time frame of the moving average, the stronger the indication and the greater potential for volatility. That's why we see the S&P 500 here. It frequently bounces around these top two lines, right? The blue and the orange. It's frequently trading through it, below it, back above it, back below it, back above it. And that's because the 9 and the 20-day, which are the blue and orange that you see here, they are more volatile because they are a shorter time frame and they have less data points. As we go further down or increase the length of our moving average, you can see that the 50-day, which is the purple line here, the S&P does touch it. It does go through it, but it definitely touches it less frequently. And if we go all the way down to the 200-day, you can see, since the last time we touched the 200-day was in June of 2020. And if we go back to the COVID crash, obviously we went right through it. But if we look back to 2010, so going back 10 or 11 years, you can see how infrequently or how rarely the S&P 500 has traded below its 200-day moving average. In fact, anybody who used that 200-day moving average as an indicator to buy or invest more, you would be making some serious returns relative to the average. So the summary there is that it's used as an inflection point where buyers and sellers will take action, and the greater the time period of the moving average, the more action is going to happen, and the greater the support or resistance level that will be. Another common way in which moving averages are used are when multiple moving averages actually converge on each other. Rather than focus on the moving averages relative to the stock price, traders or investors will focus on the moving averages relative to each other. There are two terms in trading. One is called the golden cross, and this is when a shorter term moving average breaks through a longer term moving average. This is an indication of a bullish breakout because this implies that the shorter term or the more recent price action has been significantly up when compared to the more longer term price action, which is what's driving that longer dated moving average. For example, let's take a look right here. Let me just get this image out of the way. Here we have the 9 and the 20 days on our screen right now. The 9-day is the blue line, the orange is the 20-day. So right here where my cursor is, you can see that on that day, the 9-day actually broke above the 20-day. And that is normally an indication that there might be further upside because it's a confirmation of a bullish trend forming. And we did see for the days following that, we got 4 straight days of gains on that golden cross right there. Now the reverse of that is called a death cross, and that is when a shorter dated moving average moves through a longer dated, and that implies a decisive downturn in the market, as the more recent price action has been in a downtrend relative to the longer term price action. And so we can see again that the 9-day can break below the 20-day, as we see right here, and that can be an indication for further downside, which is what we did see in that S&P 500, as you can see there. The downside to moving averages as a whole are that they are lagging indicators, so most of the ways that moving averages are used as confirmations of trends will only actually appear until after a significant amount of retracement has already happened. Like for example, when we see this death cross right here, there's already been some downside that's taken place to actually cause that death cross. And similarly, when we see the golden cross that we just showed you, there had already been some retracement and some moves to the upside before that golden cross actually takes place. The way that moving averages are calculated in their nature are just using previous price data, so it's going to take time for any market to actually reflect its movement or its momentum in the moving averages themselves. For example, one of the most violent death crosses we've ever seen was during the COVID period, and a big death cross indicator is when the 50-day breaks below the 200-day. That's one of the stronger death crosses that you'll see, versus a 9 versus 20 or something like that I just showed you. A 50 to a 200-day death cross or a golden cross, you pay attention to that. Now here in the COVID crash, we see that the 50-day broke below the 200-day right here on March 27th, and we had already seen some violent downside going back to February 21st, before that death cross took place, and it was, in fact, even after the bottom in prices, which was on March 23rd. And then, again, with the golden cross, the 50 to 200 is a big golden cross as well. That doesn't take place until July 8th, 2020. And you can see how much upside you would have missed out on if you're purely trading or purely going on golden cross and death cross. So it is a lagging indicator. For that reason, it's good to be paired with some more leading indicators or leading technical analysis tools in order to better help your trading rather than being looked at purely. Again, the main way that I like to use moving averages is in conjunction with other indicators. One, I have others here that I'll be showing you later in other videos or in future videos. And I like to use them as inflection points, knowing that there's going to be a lot of action at these indicating prices or at these moving average prices. So that's the main way that I like to use them. Moving averages really are a core piece of many, many different indicators that investors enjoy using regularly. And that's why I chose to cover them first. There's traders that will use them as a way to track when the stock has gotten a certain distance away from the moving average itself, and this is called Bollinger Bands, as you can see here. Other traders will use multiple moving averages and just focus on whether they converge on each other or separate too far from each other. This is called a MACD indicator, as seen below. There's countless others, and we'll be going through them in future videos. But for now, go ahead and get some moving averages up on your charts Start to experiment or play around with SMAs or EMAs, whichever you prefer, and feel free to drop any comments or questions so that I can help you guys get started or improve your trading journey. Thanks for watching today's video. Don't forget to like and subscribe to our page, as it really does help me continue to help you guys. Happy trading. Let's make some money.